Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we began a new course on strategy development, which is being put together by Informed Trades community member and founder of system programming website OneStepRemoved.com, Shaun Overton. In today's lesson we're going to continue this course with a look at how to take the inspiration moment we learned about in Shaun's last lesson and start turning this into a rules-based strategy. So let's get started.
Hi, this is Shaun Overton with OneStepRemoved.com in partnership with InformedTrades.com. In today's lesson, we're going to take our core strategy concept and we're going to define specific entry and exit rules. The last video, we defined our market as the Forex market and the core strategy concept as buying when the RSI is overbought, which implies we sell when the RSI is oversold. The entry rule in this case kind of makes itself. The first place we'll start is buying when the RSI equals 70, which signifies overbought, and we'll sell when the RSI is 27. And then for the exit rule, that's what we're going to discuss mostly in this video, and this is where it can get quite complicated. The first one is you could use an unrelated indicator. I have never seen anybody come up with a system that has an unrelated indicator that works for any extended period of time. So I don't know if it's a mistake, but my experience would tell you to avoid it. To give you an example, if you have a strategy that enters when the RSI is overbought, and then you try to define an exit based on the stochastics, you could get some really unusual performance, because when the RSI is overbought, stochastics might be down at 50. Or it might be overbought. You have no idea where it's going to be in relation to the RSI, which makes it impossible to define a consistent exit. The second option, and this is what we're going to do as the strategy moves forward, is we're going to keep it really simple. We're going to define our entries based on the RSI, and we're going to define our exits based on the RSI as well. Really simple to understand, and it'll go through the exact same process as if we had made it more complicated. The third option is a trailing stop, and I found that over time trailing stops can be the most profitable if you follow all of the trades. The problem is that using trailing stops, in my experience, doesn't match with my psychology. And what I mean by that is a trailing stop strategy with no defined take profits can have long series of consistent losers. So if I'm trading a strategy that frequently has 9 losers in a row, by that 9th loser, I am seriously doubting my strategy, and I don't know if I'm necessarily going to continue trading it. Whereas the 10th trade might be the monster winner that I've been looking for. And even though it works out over time, you tend to get a really jagged equity curve where it goes lose, 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 followed by a monster winner. And it tends to be a big emotional roller coaster. The fourth option is you can use fixed stops and limits and give up some upside potential. So for example, you could use and I usually define fixed stops and limits based on the average true range, the ATR. And the first place I start is using a stop of 2 ATRs and a limit of 4 ATRs. That'll be my very minimum. And then if my strategy can handle it, I'll look at something in a 3-to-1 risk-reward ratio of, say, 2 ATRs for the stop and 6 ATRs for the profit. The fifth option is to use layered exits, and this would be a combination of trailing stops and fixed stops and limits. The most frequent example I use is to define my strategy into thirds, where I'll put on the full position when the RSI goes overbought, then 1/3 of my position will exit when it hits 4 ATRs, a risk-reward ratio of 2-to-1. I'll exit the second lot when the market moves 6 ATRs, a risk-reward ratio of 3-to-1. And finally, I'll put on a trailing stop when the second lot exits and apply it to the third lot, so that if the market continues running for the next few days or weeks or months, I have the potential to catch a gigantic move. And what I found is using layered exits tends to result in better risk-adjusted performance, because you get more consistent winners, but the winners tend to be less. So you get a smoother equity curve, which is a lot easier on your psychology. Like I said before, though, we're going to keep this video very simple, and we're going to base the exit strictly on the RSI. And that's what we're going to do in our next lesson is we're going to take these entry and exit rules and define it into a computer program so we can evaluate if this strategy has any merit or not. This is Shaun Overton with OneStepRemoved.com. Thank you for listening.